All right. Bum, ba-da-bum. Hi, everyone. Apologies. We gotta love technology these days, unfortunately.
Hello. Hi, everybody. We had some technical difficulties, but that shouldn't happen again. I think we figured it out. So cool. I know Esther won't be able to make it in tonight. Don't know where the other kids are, but where I'm going to say they are. Matthew's going to be right here. So here we go.
How are you today, Emily?
Hey guys, how are you?
Good, good.
Hi, everybody.
Hi, Jay.
What do we got on? Okay, everybody's struggling in here.
Oh, wonderful.
What is it?
I'm just glad to see your faces. So
Oh.
welcome everybody to our, what is this, our third meeting officially of Stock Market Survivor. We're gonna go ahead and get started. Thank you for being patient with the delay. I think we have this hiccup figured out. So we are going to go ahead and continue. Let's first go ahead and give everybody a couple minutes to get in, but did everybody have the chance to do their homework last week from last time?
Yes.
Why, thank you, Brianna. I knew you would. Anybody else?
Most of it.
Trying to
So
remember what
you
the
also-
homework was.
Well, that's a great question. Bo, where can they find their homework?
If you go under our tribe on Stock Market Survivor, and you can go to topics,
Hmm.
and
Oh.
well, my computer, and yep. So meeting
Found
notes
it.
and homework assignments. Yep, that's where everything will be posted every following day after class.
So
Perfect.
if you go
Yes,
here
I did
and you
homework.
look on Stock Market Survivor, so this is Stock Market Phase 1.
Mhm.
So you go, can everybody see this? Sometimes it doesn't, it'll show like porn or something. I don't want to show you porn most of the time. That's a different Zoom call. Sorry, Kathy, don't, just hold on. I just want you to know, I'm trying to be respectful-ish. So, so from here, you go where? We go to Discovery?
Topics.
Topics. My brain's so fried. So right here, we have our trading tips and tricks, meeting notes and homework, and trending up replays. This is where the videos go, okay? So all of those things you're learning from the brilliant Emily are gonna be here. Make sure you follow them so you know when something is loaded. Meeting notes and homework assignments, you wanna make sure you follow that so you know when your meeting notes and homework are assigned. And then trading tips and tricks, stock websites and podcast hyperlinks, and I'm already following that, so that's great. So you will make sure you follow these things, guys, because this is all private, just to the people that are in the tribe. All of this is on your Stock Market Survivor Phase 1. So take a look at it here. This is also where we will start getting really active as a group. So you want to make sure you take time to get to know what this is, right? It's actually a lot of fun if you take the time to go through this stuff. Now, what you guys also have access to on the platform, you guys also get access to our resources down here. So for example, you should get access to all of our affiliates that we have for the IRA Club, IRA Black Book, PropStream. We have more. I don't know why they're not here, but it's probably just loading. So you also get access to, let's see, what do you guys also get access to? Wait, did I? I'm following everything. I mean, after all, it's my platform, right? This is how your startup is. If you guys have another chance to look, please come here. We put a lot of work into this to get you guys going. It talks about what you want to do about your Mighty Network here, different feeds that we do, getting everything going, the guidelines, especially to be supportive, share everything generously. We have to protect our community, things like that. So take a look at this. It also talks about what your next steps are, which are how to set up your bio page and everything like that, so we can see who you are. So this is about you guys get access to our purpose, why we're doing what we're doing. We really do want to change the world one person at a time. And we're all doing this to give way, to make a difference in ending housing insecurity. So this is also what you guys get. You guys also have access to the party chatter replays. Now these are the 3 o'clock calls we've been doing Monday, Wednesday, Friday since Corona started. So as you can see, we have quite a bit here, and at least a third of them are Emily. So you got plenty of access here. So you want to see what's going on. I don't know why this is loading very quickly, but these actually all are very, very cute. So we have even more videos that are going to be coming up. And you can also find each other here under your members, right? So we can have all of our members here, see what's going on, and so on and so forth. What you want to make sure you do is as you go through, you're going to see that you have all these different things like your introduction. These aren't very big. This very limited amount of characters that I put here, but make sure you put this in, because as we start growing, we're going to actually be using the introductions to build our teams. You can link in your Facebook and your LinkedIn accounts here, and make sure you give yourself a cute picture. You know, I like to make sure I dress up occasionally. I haven't lately, but I do I look good in a tie, and I look really good in a jockstrap, but that's a different account. So we're not going to put that here. This should be professional adjacent. So make sure you have something that shows who you are and what you're doing here, what we're trying to accomplish. So go ahead and fill that out. If you haven't had time to look, you also know you can actually chat over here on the side. See that? So we have our chats that we can have here, different specialties we've got going on. See, we got 2 of you guys here. Yay, Jamie and James, you just socks. It's wonderful. Yep, thank you. That's great. I'll go ahead and love it. Appreciate it. So we're gonna go from there. But this is different than Facebook, as in everyone that's on here is positive. Wow, that's his outfit that he chose for that. Oh, honey.
Oh, they both look great. Both photos. Yeah.
Oh, baby. He's trying to look at him. He's doing a Trinity knot with a casual shirt. Oh, Jesus. Oh, sweetheart. That's just precious. Well, that's our credit repair model from yesterday about how to build business credit. So different things for like non-parties. So you can go take a look at, we shared a lot of them today. So we have a whole new set of videos. Take a look at who they are. You will enjoy them. This one's really cool if you guys like wholesaling or if you're interested in beginning real estate. That would be a good one there. Thank you for fixing that picture. So we have all this stuff here. So go onto the home, take a look around, be active on this. It's how we're really going to be communicating a lot. So that way we'll give you guys more of a community sense. No one is posting anything about politics. No one's bitching about riots. No one's whining about elections or Corona. This is material that we want to see, okay? So don't worry, it's a safe space. If anybody gets bitchy or has an attitude, only I'm allowed for that, okay? And occasionally, no, I would say Emily, but she even is dying right now with COVID, and she's still bubbly as hell. So welcome, darling. It's that good. She's got that good upbringing, that good stuff. Yeah.
Yeah, I'm a good girl, and you keep trying to make me into a bad girl, and I refuse. I'm resisting it, but I don't know. I guess if I hang out with you long enough, I will become a bad girl. But
honey, I will give you a riding crop, and you'll just go to town.
I'm trying my best. Hey guys, I think that bought us enough time to allow everybody to come in. So I think we have everybody in here.
Wonderful.
Okay, so let's get right into it because I do not want to keep you guys along tonight. I'm gonna share my screen. And as always, I like to kind of do a quick review as to what we covered last time we were on together, and then do a quick market recap and kind of check and see what happened today in the markets, and then talk about our feature subject. So let's get right on to it, and tell me if you guys can see my little PowerPoint presentation. I actually I'm trying to make this thing pretty for you guys. So I actually did a little PowerPoint for you all. So tell me if you guys can see that.
Mm-hmm.
Yes, we can.
Okay. All right, so let's do a quick recap from last week. We talked about like the things that drive the market, and the 3 things we talked about were behavioral analysis, how consumers behave in terms of fear and greed. We talked about fundamental analysis and how we look at, earnings report, economic reports in terms of, unemployment numbers, consumer spending, Fed rates, earnings, stock PE ratios, and those types of things. And then today we're going to get into the technical analysis part of it, and we're going to really focus on these three things here, which is trends, levels, and patterns. And this is when we start looking at just the pictures and to kind of give us an idea of what is what's happening with the stock, right? Like, is the stock going up, down, sideways, like what's going on, so that it lets us know whether this is the right time to enter into a trade. So that's kind of like a little recap of what we did last time we were on together. But before we do that, before we get into the technical analysis today, I want to make sure that you guys are really getting used to having a daily routine where you're always checking the markets to kind of see what's going on. Even if you're not actively trading, I want you guys to just get in the habit of, checking the markets, seeing the news, find out what's going on economically in terms of, Fed rates, housing numbers, job numbers, those types of things. Taking a look at the broad market, we keep talking about the S&P and the Dow Jones and the, NASDAQ and the Russell, and then scanning the heat map. So I wanted to just make sure that I had it all in one area for you guys. So Bo, I'll actually just screenshot this this slide and just put it up for you so that you guys can have these links.
I was going to suggest that. Send that to me and I will post this for everyone listening under trading tips and tricks. So this will be posted there.
Yeah. So one of the things you just want to kind of get, and like if this was, me getting my day started to like, getting my day started right now, I, go through like a process where I check the news and find out, okay, what's going on. These are a couple of different websites you can go to. If you want to go to investing.com or briefing.com. I don't know if the hyperlink will work and actually direct us. Tell me if you guys can see my briefing.com now. Let's see.
Still on PowerPoint.
Still on PowerPoint. So I have to stop share and then share this screen again. Okay. How do I just share everything on this stupid thing?
You can't.
You can't. I have to keep switching back and forth.
One of those.
Unless you want to make a better product than Zoom, and then you can make all the money off of it. So that's a thought.
Go up. Yeah.
Just
make sure.
We'll see.
Just do not
All
select
right.
the incognito browser.
Oh my goodness gracious! So
Jennifer knows what I'm talking about. She knows. She's been there. We've had those conversations. Jen.
Oh goodness gracious! And actually, this is not the. I'm actually gonna give you guys the proper. Hold on. Let's go here to mybriefing.com. Do I have my little hyperlink? Because this is like something else, like a Facebook page or something. Let's go. Briefing.
I like your color scheme.
Oh, thank you. Big picture. So you can go to like a couple of different places and just kind of get the big picture. I think they changed there. Let's see. Stock market update. So you can kind of come and just kind of get like what's going on, like, get like the bulletin, like, what's going on. So you can come here and see, oh, another day, another record high. This is what's happening in the stock market. If you choose to go to investing.com. Investing.com. That's another website you can go to and just get like the bullet points. You don't need to spend a whole lot of time here reading every article that's here. You just want to get like, okay, big picture, this is what's happening. Okay, this happened today. Oh, the FANGs were up, Salesforce is up. So that's kind of giving you an idea of what's happening in the market. Once you do that, oh, I hate all these little pop-ups. So once you go through like kind of the news, and again, you shouldn't spend not much time in it. You just want to kind of get like, just give me the bullet items of what's going on. You then want to go to the economic calendar. And this is what I always give you guys every Friday. So you guys should already have Forex Factory and, like you should know it like, in and out. What I do want to show you is how you can actually filter it so that you can pretty much bypass the things that are not important to you and keep the things that are important for you. So if we were to go to FinViz and actually look at FinViz itself, FinViz, oh, where's my FinViz? That's my investing. Let's go FinViz. So FinViz Oh no, not Finviz, Forex Factory. I'm sorry. I keep getting the Finviz and Forex Factory mixed up. Let's go Forex Factory. And actually I have the little tab here already there. So let's just go Forex Factory right here. So Forex Factory, if you look at this, when you open up the Forex Factory and you just go to the calendar tab, it brings up, it's not going to have the filters already set in place. It's going to literally give you everything that's happening economically in every market, including international markets. So you have to come to this little filter tab right here and just check USD so that you get the important things that are coming out of the US market. And once you do that, it now gives you all the stuff that's coming out. And then based on the folder color, it lets you know which is more important than the other. So obviously a red folder color has high impact over an orange over a yellow folder. So this kind of gives you an idea of what's happening during the week. So this week, really nothing much until we get to tomorrow. We have the Fed chair speaking tomorrow, and then we have the Jackson Hole Symposium on Friday, which will be day 2. So these two are going to be like the major things that may impact the market. Just because it's red, it doesn't mean that it will. It's just letting you know that, that item might move the market one way or another. And it also doesn't tell you whether it's moving the market up or down. It's just letting you know that it's a high impact kind of day. So this is how you start. Yep.
A question for you. How, obviously you said that that's going to be a big impact for the markets for tomorrow. Realizing that a Category 4 hurricane is about to hit the energy sector of Gulf and of oil and chemicals, how do you think that might affect the market when it opens by like 9 a.m., seeing, what some devastation may look like, even though they can't get in there to see, but, some of these plants have, fully automated systems that can alert them to what damage has been done. So curious as to, do you think that'll have an impact on tomorrow as well as Friday?
Typically, they don't. Certain sectors of the market certainly might be impacted one way or another. In terms of energy, being that energy has already been beat up so much because of what's happening with the virus, in terms of people are not spending as much on energy. I don't know how much more of an impact that will have. But it doesn't affect the entire market. It affects certain sectors, like you just said, right? And we were actually we were talking about this earlier today, and one of my mentors was saying that they were going to go back and kind of do some research and kind of see really how that how hurricanes and storms like of such nature impact the market. They really don't. It's more on an individualized company type of thing.
Mm-hmm.
So like, somebody might say, okay, well, I'm going to look into Home Depot, because if the hurricane is, really has a huge impact, then, people are going to be rebuilding and stuff like that. So maybe looking at a Home Depot might be a play, or whatever the case might be. But again, not a guarantee that it's going to, but you just have to kind of look at it on an individual basis and just kind of look at it that way. But it doesn't have the market does not react in hurricanes or snowstorms or stuff like that. If it's oil related, sometimes.
Well, that's what I was saying, because it'll wipe out some refineries probably for a bit. So I remember back when Katrina hit in 2005, you had your gas crisis across the entire country because it knocked out all the oil platforms and refineries in the Gulf and along the coast. So I remember that. So I was just curious, because I know there is a large portion of the refineries that are out towards the western part of Louisiana. So I was just curious as to how that might
and that's where, like, you, the individual, will have to make a decision as to how you want to approach that. If you obviously have, let's say you're heavily invested in the energy or oil sector, right? Like maybe you have a portfolio, or maybe you work for a company that's giving you stock options in certain, energy companies or whatnot, right? Maybe that's the time that you would look into maybe buying and we haven't gotten into options yet, so I don't want to confuse anybody, but there is, you do have the ability as the investor to go in and buy put options to at least hedge while the hurricane is passing through. And then if nothing happens, you can always, get out of that insurance or that put option once it passes, right? So that will be more like on an individual base type, depending on what you're heavily invested in your own portfolio.
Cool. Just a question. Sorry, I didn't mean to sidebar too much.
Oh, no, not at all. Not at all. Glad you've got the questions. So this is where we come in to get the economic data and just kind of find out what's going on that week. And this is how traders kind of like, look to see, all right, what kind of week are we looking to have? Now, mind you, something that's not in this calendar might happen or might come up where it still affects the market one way or another, like a tweet or something. But for the most part, at least this kind of helps you prepare, like, okay, maybe I'm going to trade on Monday, Tuesday, and Wednesday and take off Thursday, Friday, because there are two red, there's one red folder on Thursday or, and one on Friday, and I don't want to be in the market when that happens. So this is how you as an individual can really start to design how you want to go around trading and investing in your own portfolio just based on what's going on economically, if you want to use that approach as well. But it's good to kind of know and have an idea of what's coming, because you don't want to get hit by something. You don't want to like get a surprise in your account. It's like, oh my God, I didn't even know that the Fed was speaking this week. Now, again, these used to have a lot more impact than they do now, but it's still nice to know what's going on economically. And then the last thing we look at is analyze the broad markets, which we're going to go do right now, and then look at the heat map, and then we're going to get into our feature presentation. So let's see what happened in the market today.
So you would typically want us to go in that order: investing, Forex, Factory, FinViz.
Yeah, and yeah, these are just choices. Like these are just options that you have. You can certainly go in other platforms, but these are just the most common ones that people go to. And it doesn't mean that you have to go to all three. Like you can just go to briefing and just get it's going to be similar anyway. It's not like, briefing will report one thing on Apple and investing.com won't, right?
Yeah, right. No, they're all going to have the same general info.
Yeah, you're going to get similar news. But yeah, these are just kind of like the choices that you can go to. Forex Factory is just the only one that I know that has that calendar. We can kind of go and just get all the information all in one place. And then FinViz is where we would go to look at the broad market, see what happened, and also look at the heat map. So this link right here, and I do not want you guys to jump the gun. So you have to promise me that you're not going to jump the gun and try to get ahead of yourselves. But this link right here is to our YouTube channel with Tackle Trading, where we analyze the markets every single day at 12:30. And we typically go for about maybe 2.5 hours, just kind of going through that whole process. So if you are, one of those people who I just want to save time and just get everything all at once in one bite sizing, you can just go to the live YouTube that we have at 12:30 every single day and kind of get the analysis from coaches and instructors that are looking at the market real time. So this is where you would get like real time what's happening in the markets right now. But I don't want you guys to get ahead of the game. I want you guys to, to actually know where these sites are so you can go and start to practice them. But if you ever just wanted to kind of see what we talk about on a daily basis, hop in there. We do it every single day at 12:30 Eastern time. And then, of course, we then want to go scan the heat map, get a lay of the land and kind of see what happened. The reason we want to scan the heat map is to prep to enter new trades, because eventually the reason we're doing all of these things is because we want to get you to the point where after you've done your market analysis, after you've checked the news and you've done the economic calendar and you've gone through the broad markets and kind of, determine what your market posture is, you then want to go in and find a trade to make. Because the reason you're looking at the broad market is to determine, okay, is the market bullish today? Is it bearish? Is it just sideways doing nothing? Based on whatever your determination is of the market that particular day, your next thing is to go in and look at the heat map of the sectors, and and figure out what you want to trade that particular day. That's at the end of the day, that's the whole goal. It's not just to read an article and say, okay, that was nice. It's for you to then be able to make a decision, determine where your posture is in terms of the market, and then enter a trade. That's the whole idea of this whole entire process. So I don't want you guys to think that, all I'm doing is just kind of giving you guys assignments to just go read stuff. It's like a layer, right? We're going step by step by step, ultimately to get you to the point where you have to make a decision and look and see which stock am I going to trade, or which ETF do I want to trade today, and so on and so forth, if that makes sense. Cool.
Yes.
All right, so,
what time does the market open? Like, if I want to check it at 3 in the morning when I wake up, can I do that for that day, or what time does it refresh?
So the market opens at 9:30 and closes at 4. So anything that you get right now will be everything that happened today. So you can do it this way. You can do pre-market. So you can get all the pre-market news, which will pretty much give you the lay of the land of what happened yesterday, right? Or like the day before. Or you can do post-market, which will give you the lay of the land of what happened today, right? And then there's always news being updated throughout the day as, markets are still open. And if there's any news, they will keep updating them. So like if we were to go to FinViz here, I'll show you guys, because that's where we're gonna go next, is to get a lay of the land and see what happened. If you go to Forex Factory, let's go to FinViz. That's briefing. No. Where's my FinViz? So if you go to FinViz, and even if you went to FinViz and just kind of looked at the news, you can see it's updated as, real time. So you can come and see the news that were happening throughout the day, and they'll post them as they go. If there's anything after hours, it will just keep getting posted. But again, I don't want you to spend, a whole day looking at every article. I just want you to kind of get the lay of the land of what's happening. So whether you're looking at it at 3 o'clock in the morning, if you're looking at it at 3 o'clock in the morning, you're going to get the information that happened that day or the day before, right? If you're looking at it in the morning when the market's open, you'll get information that's starting, for that day. And you can always, go back and look at the previous day, but that's not going to matter for today. If you're looking for something to trade today, then it's going to be the news of today, right? So that you can be able to participate in the market, because tomorrow it could be a completely different story. So with FinViz, here we are. We can now take a look and see what happened today in the market. If you want to kind of get like a broad idea of what happened in the different sectors, like we always talk about, they're always going to be posted up here. Okay, but if you have a broker and you already have a brokerage account open, that information will be in your brokerage account, because once you have a brokerage account open and you go to your Thinkorswim platform, you will have that already laid out there. You just type in the ticker symbol and you can be able to look and see what happened in the markets, that, see what's happening with the different indexes. So if I pull up my Thinkorswim, and let me know if it comes up. Where's my Thinkorswim? Here we go, share, boom. So with my Thinkorswim, I can just literally just go through the charts here and just type in the different indexes. And you guys remember we talked about these last week. The S&P is the broad market. So once again, you just want to kind of get a lay of the land of what's happening overall, so that you can determine what your posture is in the market. So there can only be 3 things that the market will do. The market will either go up, it will either go down, or it will remain kind of sideways, meaning like there really isn't that much of a change. Okay, so just by looking at today's price action, what do you guys think happened today? We're looking at one
It was a good day.
It was a good day, right? Because we created another high, right? Same thing with the Dow Jones. Let's look at the Dow Jones now. Comparing the Dow Jones to the S&P, it was still a good day, because we're still continuing to make new high. We're still continuing to go up. If we look at the NASDAQ, Look at that. We made another new high. We had a 2% day today with the NASDAQ. So that to me, and then if we look at the small caps, so now compare the small caps. The small caps today were literally unchanged. Like it was, nothing happened today, right? So looking at the S&P 500, once again, let's go through each one. This is the S&P 500. The S&P 500 had a 1% update today, okay? The Dow Jones, not much of a change today. This was just up 0.30. And then the NASDAQ, up 2%. And then the Russell, it was pretty much unchanged. Okay, so if you're looking at that, then you have to determine, okay, where is my posture? If obviously if the market is going up, then you're going to be looking for trades to trade upwards because the market is going up, right? And that's how you start to now scan for companies or ETFs and so on and so forth to get you going in terms of what you're going to find to trade for that particular day. But let's get it back into the presentation and talk about today's topic, which is technical analysis. So let me get back into that. And guys, if I'm going too fast, let me know, stop me, interrupt me so that I make sure I don't leave anybody behind. But you know, here's what we're going to talk about today. We're going to talk about technical analysis. And technical analysis, all it is just pretty much we're just studying the price action of the market. Right? We're looking at charts, we're looking at companies, we're looking at ETFs to help us determine whether it's the right time to pull the trigger, right? Based on what it's giving us, we can either be buying to enter into the trade, or we could be shorting, meaning that if the stock is going down, you can short it and make money from it going down. So we'll be looking at those different things to help us determine you know, when is it the right time to pull the trigger? That's all that the technical analysis is to help you figure that part out, okay? Now, before we get into all the different trends, patterns, and all the other good stuff, I kind of want to give you a little bit of like a very quick, you know, lesson on the different chart types. I don't know how old you are. I don't know, like, you know, whether when you were born, newspapers existed back in your day. But the types of charts have evolved over time. And these are the three types of charts that people use to read, to get that technical analysis and kind of understand what's happening in the markets. One of the charts that people use is called a Western bar. Typically, this is something that you would have seen in a newspaper, like if you were looking at like the business section or something like that, you probably would have seen something like this with, you know, with a Western bar. The Japanese candlestick is what's commonly used now. You'll see that in charting and trading platforms like the one that I was just looking at. And then you have your line chart, which pretty much kind of show, it's usually like on TV and multimedia platforms and stuff like that. But this is what's commonly used for investors and traders. And it also depends on when you started trading. I still know people that still use a line chart because that's when they started trading, they were taught using a line chart. So that's just what they prefer. I don't know of a lot of people that use the Western bar, but again, you know, you might have seen it like somewhere in a newspaper or something like that, or in an article, but you know, I just kind of wanted to show you what they are, but they all give you the same data points, or they kind of give you the same information. How you would read a Western bar. So let's assume that we have, or actually not assume, but we're looking at two different movements here. We have, oops, wait, I went too far. We have a green, which means it's an up day, and then we have a red, which means it's an up day. So the way you would read a candle, a bar chart that was an up day, the only thing that you would notice is the difference is where the close and where the open is. So the high indicates at, you know, which the price that stock went up, like the highest it got that particular day. The low is giving you the low point of where that price went that particular, at whatever time frame you're looking at. The open is where the price opened, and then the close is where the price closed. Was that a question? Or somebody sneezed? I couldn't tell. But the opening price is always going to be to your left. So if regardless of whether the stock price went up or down, this little line is where it will indicate that it's open, because when you're looking at the chart itself, it doesn't have this high, close, low, open. It just has like just the actual line. So it's up to you to know what they mean and what they represent. So if you're looking at the line to the left, it's telling you that it's the open price. If you're looking at the line to the right, it's telling you it's the close price. This up here is your high and this is your low. So this, for example, if this was a stock, if we're looking at a stock for Apple opened here, it got as high as here at one particular time frame, it got as low as here at one particular time frame, but this is where it closed. On the flip side, if the price went down that day, the high and the low remain at the same place. The only thing that switches is the open and the close, meaning the stock opened here, it opened up, and then throughout the day, it had a sell-off and closed here. So the price went down that particular day. So that's how you would read a Western bar chart if you ever saw it somewhere. But what we mostly use as traders and investors is what we call the Japanese candlesticks. And this is what you will most likely see when you're looking at a chart, is representation of green and red. And again, the green indicates that the stock price opened at a lower price and closed at a higher price. And the opposite would be the stock opened at a higher price and closed at a lower price. The high and the low will always be there. So these are what we call the shadows, right? So you have an upper shadow, which indicates where the high was, and you have your lower shadow, which indicates where the low was, the opening price and the closing price. This is what we call the body. So between the open and the close is what we call the body of the candle. Okay, and then the range is what you would be looking at from the high to the low. How much did that stock price move that whole entire day? That's what you call your range. Okay, so and then the opposite for a down day candle would just, the only thing that you're switching is the open and the close, which means the stock opened here and closed here. It opened higher but closed lower, and at some point during the day it got to this price level right here, and at some point during the day it got to this high price right here, but this is the body, and once again this is the range. Any questions on reading a candlestick?
So Emily, those little candlesticks at the top where it says the high, that's just what it did just during the day, and the body's just open and close. So
you got it.
So it opened there, and then it reached that high just at whatever point in the day, just for a second, for however long it reached there, and then it dropped back down. And then
you got it. So yep, and I'm going to be doing this quite often. I'm going to be going back and forth with it. I'm going to show you like the presentation, but then actually show it to you real time so that you guys can get an understanding for it. So let's take a look at Netflix today. So look at Netflix. Who can tell me how Netflix did today?
Good.
It did good. Was it a green candle?
It's a big green candle.
Big green candle. It's a big green candle. So looking at Netflix today, and once again, I'm just gonna move. Let me see if I can actually, can I draw on here? Let's see. I think I can. Yay, I can. Actually, I didn't have it on today. All right, so here's this little, I'm gonna highlight here, right here. So again, your trading platform will always have these data points somewhere in the chart when you're looking at it, but this is where the Thinkorswim one is. So this is today's candlestick. Today is the 26th, right? That's the date. The opening price was $492.50. Okay, so down here, the high price was $549.04. That's your upper shadow right there. Can you guys see that?
Yes.
Cool.
I
Who
can
can
see.
tell me? Who can tell me what the low of the day was?
Well, probably not.
492.08.
492.08, and it's very hard to tell, but it does have a little bit of a wick down there. Let me see if I can zoom in so you guys can actually see it. But today it was just one of those bullish days. It didn't even have a low. Like, it just opened and ripped. So you can hardly see it, but there is a very low shadow right there at the bottom there. But if you're having a hard time seeing it, it's going to be up here. So the low of the day was 492.08. Who can tell me what price it closed at?
547.53.
547.53. And then what was the entire range?
The 56.96. So if someone would have bought it this morning and then sold it at the end of the day, they would have made like $57 a share. Is that how this is working?
Yes, sir. At whatever. Yeah. So now, yeah, exactly. So if they bought wherever their entry price was. So when the market opened today, it opened at it opened at 492. So if you already had an order to buy at whatever price you had the order to buy, maybe you said, buy it at 500. And we'll start talking about this when we talk about support and resistance and entry levels. You may have had an order that said buy Netflix if it gets above 500. So you'd have gotten triggered in when it reached 500, and then you would have ridden the whole thing up until wherever you felt comfortable to take your profit. So that's one example of a candlestick. So now in comparison to one that had a down day, you can look and see, okay, this was obviously a green day. So this opened here and closed here. A down day would be when it opened here and closed here. That's what gives it that red body, right? That red color, because it opened at a high price but closed at a lower price. And once again, the high and the low of the day, and then the body and the range. Does that make sense?
Yes.
Awesome. So we can take a look at another one and kind of see. I want to test you guys, and you guys can tell me whether it was. And again, the colors will tell you immediately, but I just kind of want you guys to get used to just like the opening and the close. So here's an example of Home Depot. What did Home Depot do today? Who can tell me what the high of Home Depot is real quick?
292.12.
292.12, right? And because it actually made an all-time high today, the software platform, and I don't know if all software platforms do this, but I know Thinkorswim does. It will actually just tell you on there that was the highest it's ever been, and that's the highest it was today. So it made an all-time high of 292 today. I'm looking for something that actually went down, but I don't know if anything went down today. Let's see. Actually, we can scan and look.
TGT.
TGT did. It was like minimal. It wasn't anything that was like,
Oh, wow.
But you can see that it was pretty much unchanged, right? It was only down 14 cents for the day, but yeah, it's there's your candlestick for the day for Target.
Can I just ask you while we're on this? Is the price on the far right column, is that the current buy price, 152.71?
Yes.
If you put an order out there, that's right now the highest.
That's where the price closed. Yeah, that's where the price closed at today, right? So if the market was open, it would be fluctuating as the stock price is moving throughout the day.
Oh, so it's not showing aftermarket.
No, it's not showing you aftermarket. It's showing you the current price right now. Aftermarket, if it is moving much, you will be able to see it here. This is where your bid and ask spreads are right here.
Okay.
You can see it. So you can see the bid the bid is 152.30 and the ask is 152.88. So, but this is what the price was at the time the market closed. But if the market was open, that price would be fluctuating as the price moves up and down throughout the day.
But the last 5 days, it's been moving sideways. This stock.
Yeah, it's been moving sideways. Yeah, it had a really good earnings report when it reported its earnings, right? And then it gapped up So this
Yeah.
was the price before it reported its earnings. It was sitting like right around 136, and then it had the gap at the open when the earnings news came out, and then now it's just kind of sitting sideways. And Target is not one of those high flyers like an Amazon or a Netflix or a Tesla. Once it does this little gap, it's probably going to stay in this range for quite some time, until it has, another earnings report or some other news event or something that would make it move. But as you can see, Target is not one of those, high flyers that's gonna pop. If you're looking for, to trade Target, you would have to have a specific, strategy of how you're gonna trade it. But you're not gonna be getting those high flying, pops like a Netflix or, or like a Tesla.
Hmm.
Any other questions on candlesticks and how to tell whether it was a green day or a red day? No.
Mm-mm.
All right. So back to Netflix here for a second. We can actually go intraday. So remember how we talked about the different time frames, right? So this just kind of gives you what the overall information was for the actual day. But you can go intraday, and I'll show you guys this when we look at our examples of how to start getting into trades, of where you could have found an entry point, at some point during the day. So if we go down to like a 5-minute time frame, right? Even though that daily candlestick just kind of gives you like a rocket just shooting up, you can see that it didn't just, throughout the day, it was kind of going up stair step, right? So there were multiple entry points for Netflix throughout the day. Even if you feel like you missed it at the open, because of the intraday time frames, it now shows you that there could have been some entry levels at some point during the day to catch some movement. And the whole idea about trading is that you don't have to capture this whole thing. If you captured the whole thing, that's wonderful, right? But the whole idea is to just try to catch a movement. And we'll get into this in just a few minutes. But this is an intraday time frame. So this is giving you what happened in Netflix within 5 minutes. So each candlestick now represents 5 minutes. So even though it was a completely green day, were there times where it was, coming down and, and within the candlesticks and the time frames, it had a red candle? Yeah. So not every 5-minute candlestick was a green candlestick. There were times where it was going down within those, those 5-minute time frames, if that makes sense.
But it also means that you could have bought at the 549, not 549, but right off it. There was a down right before the 549.
Yeah, and we're gonna get into support and support and resistance levels, and we're gonna see where, how we look at, certain support levels to determine, that's the floor, and then resistance levels to find trigger points to get in and get out. So,
Okay.
but yeah, there were definitely a lot of places that we could have, if you could have waited and gotten in, if you were still looking to play Netflix today. So back to our presentation. All right, so you guys get that with the candlesticks, right? So in terms of candles and being able to identify the trends and figure out what you want to do, market really does 3 things. And I kind of talked about this earlier. It either goes up, it goes down, or it goes sideways, right? So Netflix today, and I want you guys to start to, get these words and terminology in your system, right? When we say bullish, we mean that the market went up. Whether it was a particular stock or an ETF, whenever somebody says bullish, think up, right? Think green, think, it went up. So when you hear bullish, bullish means up. When you hear bearish, bearish means down. When you hear neutral or sideways, they both mean the same thing, it's sideways. Sometimes somebody might say that they're long. If they're long, they're also trading the market, they're trading up. So that means they're long because they want the stock price to go up. If they're short, if you're short the market, that means you have a bearish posture. So bullish and long mean the same thing. Bearish and short mean the same thing. Sideways or neutral mean the same thing. Okay, so one of the things that you want to identify when you're looking at charts is to identify the trend, right? Is it going up? Is it going down? Is it going sideways? So when we looked at the S&P today, it's going up. So we can all agree that the S&P, or the market itself in general, is bullish. Do we all agree on that?
Yes.
Cool. So once you identify the trend, then you have to we do identify the levels, right? You guys, whenever I do the market update, I always talk about, support levels and resistance levels, and we wanted to, hold the line at this support level or hold this resistance level. So I kind of want to help you guys understand what those two things mean. And support, just pretty much, if you are like, if you're looking at like, a chart, right? And the support is like the floor, right? You want something to hold you up. If you're sitting on a chair, you want the chair to hold you up. The chair is a support. If you're on, in a building, the floor is your support, right? That's what's holding you up. And then the resistance would be what you would call the ceiling, right? So support is your floor and your resistance is your ceiling. So we're always looking to see where the support levels are and where the resistance levels are. So if you're looking at a bullish uptrend, right, this is resistance, this is support, right? This is resistance, this is support. And what we're looking to do is just watch the stocks build these patterns where they're giving you support levels and resistance levels, support resistance levels. And it's the same thing for a bearish downtrend where you're looking for the same thing, right? Up, down, up, down. But we're not gonna get into a bearish downtrend right now. We're gonna really just be focusing on the bullish uptrend. But just kind of know the same thing. If it's going up, it's going to give you those higher highs, higher lows. And if it's going down, it's going to give you those lower lows, lower highs. So you'll be able to look into that. And then the other thing we want to do is now identify a pattern. We've looked at the trend. We've seen, okay, it's going up. We've seen the levels. We've identified support and resistance level. And then now we want to identify the pattern and see so that we can help figure out the probability of profit. Is there enough meat in this bone for us to make a profit once we identify what pattern it is that we want to trade.
Hey,
so
real quick, before we jump into a bunch of pattern stuff, can I share something with the class?
You sure can.
Oh, right on. All right. Guys, what you'll find is that these levels have a memory over extended periods of time. I've seen levels be remembered 20 years, guys. Literally, like it was important 20 years ago, and then it becomes important again today. Why? Because we all look at the same stuff. So we make it important. The most interesting part of technical analysis, this whole field that we're studying, is that it's a constant series of self-fulfilling prophecies. We think price might stop somewhere, therefore we sell, therefore it stops. So we make all of it happen. So once you understand how we all think, then you can move in unison with each other, and that's where you make your money. But what's so interesting is that it's very easy and very visual to see once you see it. So we were talking about Netflix earlier. So I wanted to show. Now, what screen am I showing? Am I showing Thinkorswim at the moment?
Yep, we see it.
Okay, cool. So what I did is I drew some lines across, and what you'll see is that the market has a strong memory of these price levels. You can see it was a ceiling over here, then it was a ceiling again, then it was a floor, ceiling for a little bit, a floor there. This level then became a ceiling, a floor, ceiling, ceiling, kind of almost a floor, not quite, but then floor, floor, again, possible short-term ceiling we broke out today. But what you'll find is that it does very much look like a stair-stepping motion in the stock market. And once you start to see these levels, you can't help but to see them. They're like, so they smack you in the face. It's like when you buy a new car and you're driving down the road and everybody else bought the same car you did that same day. It's like your brain knows to pay attention, and you see them everywhere. But one of the biggest things that a lot of new traders get caught up on, and this was the point I wanted to make, is although I drew lines that were just horizontal, they're more like this box here. It's more of a zone than it is a distinct price level. So 450 right here-ish was kind of, a lot of people would say, hey, that was the ceiling over here, ceiling over here. But then notice the ceiling was like 475-ish, right? Floor was like 470 something, 60 something. It's always a little bit of a range, right? So I want you to know, as much as this is very scientific and kind of process-based, it's also kind of an art form, right? You kind of, it's a little abstract. It's not a perfect science. And don't draw a line at, like, for example, 500 and think if it goes to 501, we broke. It's more of kind of a fluid price level. And I've seen people get caught up on that. And I just wanted to say, even though it's a level, it's more of a zone like this box than it is a one distinct price level. So that's something I've seen a lot of people get caught up on. I just wanted to kind of make that point.
Cool. Appreciate you. Cool. So yeah, so like as Jake was saying, when we identify those support and resistance levels, the reason we're doing that is because we want to identify where we're going to take profits and when we're going to have our stop losses. Those are the things that kind of help us figure out, okay, this is where I know I'm going to be the target as my entry. I'm going to use this as it's there to help assist you in making a decision as to how you're going to plan your trade so that you don't have any emotions towards it. Does that make sense?
Yes, sorry, I was muted.
Okay, you
My
guys are all
apologies.
on mute.
Totally. Yeah.
Okay.
Well, and it's
all right.
asking yourself too, what's realistic, right? Because a lot of times if you buy a $5 stock, it doesn't mean it goes to $100.
Right.
That's not, just because you want it to happen doesn't mean it's going to happen. Now, sometimes it does, right? We've seen it a few times. Tesla starts the year at 200. It's scraping 200. Sometimes you get those, but that's not the majority, right? So it's very important to make sure you stay grounded in numbers and say, all right, what is the most likely? And what you'll find is that this entire field of technical analysis is the study of probability analysis, the study of likelihoods. What we do is we take a step into the unknown consistently, keep taking steps into the unknown with just a likelihood of success. And that's what we do. We take a little bit of risk for a greater reward with some uncertainty, but we want to make sure that we're most likely to succeed. And following these helps us make sure we stay like that.
Yep, you got it. So in terms of trends, right, and we talked about this again. So so one of the trends that you guys we're going to be working on and talking about a lot is because it's one of the most easier ones to recognize when you're looking at charts when you're completely brand new is what we call a bullish uptrend. And once again, it's not going to always be a pretty picture, but it's going to look something like this, where it's just continuously going up, right? It's appreciating over time. It goes up, it has a little bit of a retracement where it slows down a little bit, it finds a floor and goes up again and back down and goes up again and back down. So what a bullish uptrend means is that price is appreciating over time. It's giving you what we call higher highs and higher lows. So it goes up, it gives you a higher high. When it comes back down, it doesn't go back all the way down to another low. It just finds support here, like Jake said, muscle memory, and goes back up again and then back down and back up again. Same thing so a sideways trend would just be where the pattern it doesn't change. It's just a repeating pattern. It's just up, down in a certain range, right? And then a bearish downtrend would be the price is depreciating over time, meaning it's going the opposite direction of what a bullish uptrend would be doing. So with a bearish downtrend, you're getting lower lows. And when it tries to go back up, it doesn't go back to that previous high. It's giving you what you call a lower high, and then going back down and giving you a lower low, and then a lower high, lower low, and so on and so forth. So that's how you start to identify the different trends in the charts, right? So this is a bullish uptrend, this is a sideways or neutral pattern, and then a bearish downtrend. And the reason we're doing all of these and identifying all these different trends is because there are different ways to trade it, right? We're going to be talking about the stock market and buying and shorting stocks in this session. But when it comes to now options, there are very different ways that you can actually play that in terms of call options and different strategies and so on and so forth. So again, so now when we put everything together, right, we've identified the trend, we've identified the levels, and then the patterns, right? So we want to now put it all together and kind of look at it, right? So here we are, let's say this is, this is the beginning of a chart that we're looking at, right? We're getting those higher highs and a higher low, right? You get a higher high, you get a higher low. You get a higher high, a higher low. And this is typically the trend that will continue to happen until it's no longer the trend. You guys probably have heard me say it, or even Jake perhaps say it, the trend is your friend until the end, right? So this is gonna be the trend that will continue until it's not. So when something is bullish, trying to be the contrarian and trying to say, okay, it's going to go down. Well, no, you don't know when it's going to go down. And trying to short something that's on an uptrend, it's like, well, how do you know when it's going to stop going up, right? So you just trade what you see until it changes the pattern. When it no longer gives you a higher high and it starts giving you a lower low, then that trend has ended and it's now starting another trend, right? So this is what you want to be looking for whenever you're looking at charts, is to identify those trends, right? So once again, it just keeps doing the same trend over and over and over again. So a bullish uptrend, you would be a buyer, right? So you're going to be long. You're bullish, so you would be buying something because you are anticipating to make money with the stock price going up, right? Once again, it gives you a higher high and a higher low. Support and resistance, right? Finding that floor and ceiling, going up, going down, going up, going down, going up, going down. That's a bullish uptrend for a buyer. For a seller, again, it's going to be the opposite, right? It's going to give you the lower low and the lower high, lower low, lower high. It tries to go back up again, but does not quite reach this previous high there, right? And comes back down. Same thing. Now it gives you a lower low. That's your new support level. Then it goes back up again and hits a resistance level and comes back down again. So that's what we look at when we're looking for a downtrend, right? And this is what you would call a bearish downtrend. If you're looking at a stock that's going down and you see this bearish downtrend, you're not a buyer, you're going to be a seller because you are shorting this particular stock, right? So once again, you can see your resistance levels, you can see your resistance and your support, your resistance, your support, your higher highs, higher lows, higher highs, higher lows, and so on and so forth. And that's how you would look at a bearish downtrend. Now, just because the market is going up doesn't mean that there aren't stocks that are going down. So people always assume, or people always think, well, if the market is going up, then everything went down. Not really. You can still find bearish downtrends in a bullish market. Okay, so now when we look at candlesticks, and we talked about the candles that we were looking at, right? And we looked at, the one that opens high and closes, and vice versa, one that opens high and closes low. But really what we look at in terms of how we figure out how we're going to enter into a trade is really by two types of candles. We look at big candles and we look at small candles. The big candles will show you more, strength, right? If you see a big candle, it's showing you that there's strength in the market. There's strength in that stock, right? There's momentum. There's more buyers coming in that particular stock. Like with Netflix today, were there more buyers or were there more sellers in Netflix today? Well, it was a huge green candle, so obviously a lot of buyers came into Netflix today. When you see small candles, regardless of the color, whether it's a green or a red candle, it's showing you that there's weakness, there's slowing momentum, there's, you know, a change in posture. You know, like it's probably going to change to the opposite direction. So when you see small candles, it's showing you that the momentum or that speed is decreasing, right? So if you were looking at this candle here and this candle here versus these other three candles, right? These two candles are, you know, have strength, right? They're just big green candles. And then as you get to the top, you can see them tapering off and they're kind of slowing down and giving you that, you know, weakness and showing you that, okay, maybe this is where people will take profit, and then you'll end up seeing that red candle where now it's showing you that, you know, yeah, people are, you know, the stock is now, you know, it closed, the candle size has increased, so now the pattern might change, or it could be just, you know, it's just looking to settle down before it goes back up again. But the whole idea is when you see this is when you start to make decisions as to whether you should take profit or move your stop loss or whatever the case might be. So if we're looking at this in terms of how we actually decide how we're going to trade, when we are, let's say we're looking at this candlestick today, when we see this candlestick today, we want to see that confirmation that the momentum will continue. So when you see this big green candle, that's an indication that there's strength in this stock. So this is where we would be looking to buy. So when you see a green candle, what do? You buy, right?
Yep.
You buy. So when you see a green candle, you buy, because now it's showing you momentum in this stock. So if you get in, if you were, let's say, for example, got into this trade today, let's assume that this is, you know, one of those stocks that was up today, right? So now we're in the trade, and then tomorrow it continues up in an uptrend. So you're still in the trade, right? And then Friday, it's continuing in its uptrend. Monday, it's still in an uptrend. Tuesday, slowing momentum. So if you've been in this trade since today, right? And now we're fast forwarding to Tuesday of next week, and you see this, right? What does that tell you as the trader or the investor? Well, it's time for me to bring my stop loss up because I don't want to give up all of these profits that I have made in the last 4 days. Right? And you're doing that, you're not exiting the trade, you're just moving up your stop loss and telling the broker, hey, if it goes down below this candlestick right here, take me out. I'm not coming out of the trade quite yet. I just want to protect my gains right now. And then Wednesday, nothing, right? It's like it's giving you that sideways channel when nothing happened. It's unchanged. And then Wednesday happens. When it comes down to this price point right here, it would then take you out on Wednesday where you lock in those profits and not give anything back. Because then oftentimes what happens is if there's a bad news day, the stock might gap down where you end up going back to scratch where you were from the beginning and either end up not making any money or even losing money. But what you don't want to do, especially when you have a winning trade, is give back all your profits because you did not have a stop loss to get you out in case the stock went down. Does that make sense, guys? So when
Yes.
we're looking at candlesticks, this is all we're looking for. We're looking for those trends. We're looking for those levels and those patterns so that it can help us make a decision as to when to enter into the trade and then when to take our targets and when to put our stop loss. That's how you put it all together. Jake, do you have anything to add to that?
Yeah, and then I think Jay has a question, but the only thing I was going to add to that was the fact that the most frustrating thing is when you're up and then because maybe you're stubborn and you're like, oh, I think it'll keep going, right? You've doubled your money and you're like, but it could double again, and you just get blinded and you don't have a stop loss and it crushes you, and then you're down money and you've lost all the profits you've already made. That is one of the most frustrating positions to be in. You want to avoid that at all costs because you were feeling great. The endorphins are hitting you because you made all this money, and then you're in the dumps, you're depressed, you lost it all. What do you do now? And then it's really hard to kind of come back from that. because logic's out the window. You're just emotional all around. It's no good, right? So if I could say anything, always have a stop loss. Always. Not sometimes, not when you feel like it, not maybe half the time. It's always, especially as a new trader. Unless you intend to hold, unless that company to zero, meaning like, all right, I'm going in, I'm buying one share of Amazon, $3,500. If it goes to zero, I don't care. Then no stop loss is fine. But anything besides going to zero, I would make sure you protect your capital. Okay. So, and then Jay, did you have a question?
Yeah. So when we are looking at this pattern of the growth, does it just depend on how we're talking about last time, what kind of investor you wanted to be or trader? Like if you want to do it like every day, is that how you would set the pattern? Like it would just vary on the, okay.
Yep.
So, okay.
Yeah. So that, that example could have been on a 5-minute candle stick time frame. It could have been on a weekly, it could have been on a monthly, it could have been on any time frame. So however long you plan on being in the trade will determine what time frame you're going to look at, which leads me to my next PowerPoint. So let's get back to the presentation, and then I think we're going to have time to see if we can find something actually to.
Oh, I got a good example for you, Em.
That one? Okay, perfect.
Yeah,
all right.
yeah.
Perfect,
I'll set you up there. But that's what's so fun about this, Jay, is that once you figure out the basic mechanics, it's all the same game. So like the day trader is doing the exact same thing as the long-term investor. The only difference is the day trader is staring at 5-minute candles that are going up and down really fast, and the investor is looking at weekly candles or monthly candles. So the numbers and the math might change a little bit, but it's the exact same thing. You learn it once and you just keep doing it again and again. That's what I'm saying, guys. This becomes so cookie cutter, it's almost boring after a while. Like literally, it's just doing the same thing over and over, the same few equations, the same little bit of math, no matter who you are, which is cool.
Yep. So if you guys remember, we talked about this on Monday, the different types of traders, right? So a day trader, once again, is in and out within the same day. The swing trader just catches the pivot to pivot, right? So they just go from here, they find an entry point, they get out at resistance, they wait for it to bounce up again, they get into that and they go back and forth. The position trader would capture the pivot to pivot, the entire trend here, and then the investor captures the entire cycle, right? The investor is the one that's in it for the long haul. So if you guys remember when we talked about the longer you plan on being in the trade, the more you need to know about the fundamentals of a stock, right? So if we're looking at this as an example here, this is one of the first ways I was taught how to trade, was using this particular method. Because when I started trading, actually when I got introduced to this, I was more like that passive investor where all I had was a 401k. So I really had no knowledge as to what support and resistance was and all these different things that you guys are learning. I was just more like, okay, I bought in a 401k and I was just going to wait until retirement. So when I started learning how to trade, this was all stuff that was new to me. Like, oh my God, I didn't even know how to, look at charts and candlesticks and figure out, all these different things. But this is one of the ways that really helps a new trader really start to understand how to, number one, risk management. If there's anything that you'll hear me talk about a lot and often is risk management. You have to be able to know what your risk is in the trade before you ever enter into the trade. Because that's how you get to keep your, number one, your profits, and number one, the capital that you have to trade. If you do not have risk management and you don't understand what your risk to reward is, then you're going about this all wrong. So one of the things that, I was taught by one of my mentors, and Jake was taught by the same one, is to be able to look at a chart, figure out the trend, figure out the pattern, and then prep the trade so that you can see whether it's even worth it to do the trade. Because not every chart that you look at will be a tradable chart. It may not be if the numbers don't add up. So one of the ways that we were taught, this was called the SET method, right? And it stands for stop, entry, and target. And what you want to do is that you want to be able to figure out what these numbers are, enter and prepare the trade, and then enter it in your brokerage account, so that if the price, if the stock gets to that price, you're triggered into the trade and it's automated, and you don't have to even worry about it when you're at work or doing whatever else you're doing. It's literally all there and it's already automated. But once you've done the numbers to see whether it's a go or no go. So let's pretend that this is company ABC. Company ABC, has started, going back to this one, was at $80 at one point, and it came up to $88 and found resistance at $88. It bounced back down to 85. And then from 85, it went all the way up to 95, found resistance there, back to support at 90. And today, let's just assume that today the stock price is at $91. Okay, so now we've determined that this is a bullish uptrend, and we're now looking to get into a trade. We've gone through our daily analysis, our daily routine. We've looked at the news, we've looked at the economic news, we've looked at the broad markets, and now we've gone down and found a stock that is bullish. It's giving us this bullish uptrend, and now we want to enter into this trade. Okay, so the current price is $91. What I want us to do here together is kind of work out these numbers so that you guys can understand how we do this. Is that okay? So give me like a few more minutes of 5 minutes of high energy. Just, let's power through this, power through this, and you guys will at least have something tangible to go and practice with. And then Jake's going to give us a live example, and then we'll end the day. You guys ready?
Let's do it.
Awesome. All right. So once again, the S in this method stands for stop loss. And what a stop loss is, like we talked about in that previous slide, is the just in case. What if I was wrong? What if I was wrong in my analysis? What if, yes, this was a bullish uptrend, but something happens in the news and the stock doesn't continue to go up, it actually comes down. So a stop loss, if you want to define it, it's the what if I'm wrong, okay?
Well, and
That's
can I
what a
add
stop
to that
loss
too,
is.
Emily?
Yeah.
So yeah, a stop loss is being an exit order for sure. It just stops the bleeding. It stops the loss. It's the tourniquet on the bleeding arm, so you get out. But I also want to kind of add some context, because you said it right there and you said it perfectly. What if, some news comes out and then it stops going up? Guys, that'll happen to you, right? So it's not like you put on a trade that was wrong at all. It's just you didn't know the CEO was going to have this announcement 3 days later that, the company is in horrible positions and they have to sell everything and it's all going back. So I want you to realize, don't make it a personal thing, right? It doesn't mean anything, You're going to have trades that go against you. It's part of the business. It's just making sure that your win rate is above that 50-50 mark, meaning that if you're 51% right, and 49%, I don't use the word wrong, but expense trade is usually what I say.
Mhm.
Income trade versus expense trade. You don't have many costs in this business. Commissions went away. Just your losing trades are the expense that you have. It's not that you did anything wrong. It's just that it wasn't your day, right? The luck of the draw, the market just didn't turn out that way. So that's
Yep.
it.
Perfect. So I will explain what ATR is once we get into charting and once we start getting into indicators. But for now, just write what the rule is. It says half ATR under support. And once again, over time, stocks will create new support levels and new resistance levels. So we have a support at 80, support at 85, but it's the current support level. So the current support level right now is at $90. So when we say half of the ATR under support, it's whatever the current floor is, because stocks, again, over time, they'll create new floors and new ceilings over time. It's whatever the current one is. And the current one right now is $90. So everybody write down support equals 90.
Now, and guys, also realize the only way support has formed is that price goes up, right? So the only way something is done going down is it goes up, because before that it was still going down. You didn't know where the floor is until it bounces. So one thing that you'll get used to over time is that you never buy the bottom, you never sell the top, you never get it perfect, because you're always, and I'm sure you went over this, Em, is you always buy on confirmation. Confirmation is key, guys. That's what gives you the probability. When we're buying this at 91, it's not, oh, I think it's going to bounce here. No, it's already bounced. That's a fact. That's a true
It's
statement.
that green candle.
That green
That big
candle has
green
already
candle.
happened. We see it. I'm now just saying, I think it will continue. It's a much stronger position than thinking, hey, I think it's going to change direction right now, because it'll go higher than you ever thought or lower than you ever thought, right?
Yep. And then the E in the equation stands for entry, and that would be the current market price. So if the stock price today, and like Jake said, the only way you know it stopped going down is if it goes up. Well, the support was at 90 and the stock price is at 91. Did it go up? Yeah, it went up by $1, right? So your entry would be whatever the stock price is. And at this point, for this example, the stock price is 91. So the E in the equation is the current price, and the price is 91. And then the T in the equation is the target, right? We want to figure
Can I
out.
make a quick comment about the entry real quick, Em?
Yeah, sure.
Okay. Guys, there's a reason why it reads current market value right there. I want you to realize that that's not necessarily the most proper trading mechanics. And what I'm going to do for those of you who are high flyers and want to be ahead of the game, I'll type in another type of entry trigger into the chat bar, and you guys can write that in your notes. But I want you to realize that indecision in markets leads to so many lost opportunities. I can't tell you how many times people are like, oh, I don't know if today's the day to buy or to buy, and then they just never buy. So at some point you got to sit there and you got to click the button. So for those people, to prevent you from being a fence sitter, right? You know, prevent you from being a flat squirrel, right? Getting run over in the road. What we do is we say it's either good enough right now or it's not. As a new trader, it's go, no go. It's black and white. There's no gray area. There's no confusion. It's good enough right now or it's not, right? So if you get in that habit right now, about 2-3 months down the road, you can start using the other thing I'm going to write in. But what I find, and I've done this teaching hundreds, if not thousands of students, is that when you get too complicated with the math, then it feels overwhelming, and then you don't click the button and you make no money. And then what's the point, right? So at some point, I want you to realize, guys, no button clicking, no money. Button clicking is the most important thing here. You got to click the button to make any money. So that's the point of why the rule is what it is.
Yep. And then the target is where we take profit, right? You don't plan on being in the trade for the rest of your life, right? At some point you have to take profit. Remember, you have to put money into the trade, right? Your capital has to go into the trade. And the only way you take profit is if you actually close the trade. So there's 2 transactions that go into everything that you do. There's an opening transaction, and in order for you to take profit or take a small expense cost, you have to close the trade, right? So just always remember, there's got to be there's an opening and there's a closing. So there, in order for you to actually realize your gains or your losses, right? You actually have to close the trade out. So the target is what we use to figure out where we look to make profit. Okay. So the rule for that is what we call support plus pay. And Jake, if you don't mind, help me out and just put what pay means in the chat for me. But what pay stands for is potential average yield. And all we're doing is just measuring the past performance of the stock to help determine where we think it's going to go, right? So we're looking at previous performance, right? It went from 80 to 88, 85 to 95. And now we're trying to figure out, okay, if we're now entering at the price of 91, well, where do we think it's going to go, right? But we don't just pick a number out of the sky. We actually calculate the numbers based on previous performance. So that rule, again, is support plus pay. And again, that support level is that current support right here, which is 90, okay? So here's what it looks like. And I already gave you guys the answers here, but I want us to work the numbers together. So when you're looking at the stop loss rule again says half the ATR under support. Now, ATR is an indicator given to you in your chart. You will see it when you pull up your trading platform. You can just add it on there. For this example, we use the ATR S2. So if the rule is half the ATR under support, if this is our support level at 90 and the current ATR is 2, what's half of 2? You can shout it out.
1.
1. So we're going $1 under this support level, which means if we are wrong, and not you being wrong, but if just whatever happens with that stock that particular time and it goes down, you will be stopped out at $89, right? Your order to the market is to say, hey, if I'm wrong, get me out at $89. Do you guys understand that? You guys see that? Because you have $91 in your trade, right? If you're buying one share of this company, you had to spend $91 to get into the trade. So $91 of your capital is in this trade. If you're wrong in the trade, do you want to lose all $91? No. If the stock is going against you, it's going the opposite direction. Well, how long do you stay in the trade before you get out? This is the rule that helps you do that. Stop loss is half the ATR under support. So if your support is here at 90 and half of this ATR is 2, that means you go $1 under 90 and that makes your stop loss 89. So if you spend $91 to get into the trade and you get stopped out at 89, how much did you actually lose? What was your expense for that particular trade?
$2.
It's $2, right? Because you spend 91 and you got stopped out at 89. So you see, you don't lose the entire $91 in the trade. You only end up having an expense of $2. So now, did you say something?
No, but I want to.
Okay.
So I will say, guys, when you're figuring out how many shares to buy, that number that Emily just calculated is what tells you what you can afford. It's not how much money you have in your account that you can spend. It's the risk level you've already figured out for yourself. So let's say that even if you have $100,000 in your account, let's say that you're not comfortable risking more than $200. If you're not comfortable risking more than $200 and you're risking $2 a share, you can buy no more than 100 shares. Doesn't matter how much money you have, right? That's the proper way to trade. Risk tells you how many you can afford. Too many people look at how much money I can make. So let's say I want to be able to make $1,000 on this trade, therefore I have to spend 10,000. Horrible, right? What you look at is you say, I can only afford 100 shares because my risk rule is 200 total dollars per trade and I'm risking $2 a share. Now, what you'll find is that the longer you wait, you could maybe still take this trade tomorrow if it was up at $92, $93, let's say 93 hypothetically instead of 91, but you would never move your stop loss location, which means you'd be risking $4 instead of $2, which therefore means you could only afford 50 shares, right? So the risk is always going to tell you how much you buy every single time. That's why it's one of the most important numbers that you calculate before you ever buy anything.
Yep. And then, so now calculating the target, the formula for that again is support plus pay. And again, all we're going to do is use the previous performance. So let's do the numbers together. If the stock price was sitting here at $80 and it went to $88, how much was that in movement? How much was that in total dollars?
$8.
$8. So this first range, the stock went from 80 to 88. That was an $8 movement. The next movement, it went from 85 to 95. How much was that in total dollars?
10.
So what pay is taking those two numbers and getting an average. So 8 plus the 10 is how much?
18.
Divide that by 2.
9.
9.
9. So the average this stock ever moves is about $9. Right? So you don't guess the number, you look at the past performance to get an average of where you think the stock will go. So if the stock has an average movement of $9, you take your support, which is sitting at 90, and add pay, which we determined is 9. So 90 plus 9 gives you a target of what price point?
99.
99.
99. So that is where you would be looking to take potential profit of this trade. So now what I want you guys to really, really, really focus on is not the price of the stock. This stock price could be $1,000. We could be looking at a trade of Tesla right now at 2,000 or Amazon at 3,000. What I want you guys to focus on, and Jake mentioned this, is what we call your risk to your reward. If we're spending $91 and we get stopped out of our trade at 89, we are risking $2 if we just buy one share, right? If we buy 100 shares, just multiply it by 100, but we'll just use the number, with one share. So if we were spending 91 and we get stopped at 89, we're risking $2 in this trade. You guys see that, right?
Yes.
Okay.
Yes.
And now our potential profit is 99. So how much do we look to make as our reward if the stock price does get to 99?
$8.
Right? So we're risking $2 to make $8. Right? And the number that you want, that ratio that you want, is 2 to 1. So you only want to risk $2 to make 4, right? You want to risk 1 to make 2. You never want your risk to be higher than your reward. If your risk was $10 and you're going to only make 8, you wouldn't take the trade. The minimum ratio that you want is 2 to 1. So in this example here, we're risking $2 to make 8. So our ratio is even better. It's a 4 to 1 ratio, because we're risking 2 to make 8. The minimum requirement is 2 to 1. And that number right there is the most important number out of everything we just did. Is how much are you risking versus what your potential reward is. If this was 100 shares, you would be risking $200 to make $800. So now, where you as the individual starts to make the decision as to where is your pain point, right? You just have to decide how many shares you want to buy. Would anybody here risk $2 to make $8?
Sure.
Okay, so then buy 1 share. Anybody willing to risk $20 to make $80?
Of course.
Yeah.
Okay, then buy 10 shares. Anybody willing to risk $200 to make $800?
Yeah.
Okay, so the numbers we're getting lesser yeses. So whoever said yes, that's fine. Now you're gonna buy 100 shares, right? So you're gonna buy 100 shares of this stock. Anybody willing to make 2,000 to anybody willing to risk 2,000 to make 8,000? So you see
If
how
I have it and the stock's good, yeah.
Right, exactly.
This is a very personal number though, guys. I want to say nobody can tell you what your risk number is. And even based on account size, like I've met people that like the math says technically you can risk up to 4% of your account, but maybe you can't. And that's like a very different thing, because like the math will say you could maybe risk a certain number, but maybe you emotionally can't handle that. Like, oh my gosh, I can't imagine if I lost X amount of dollars, and everybody has a different number there. And what's interesting and I've seen this through my own journey, is that you always have that feeling. It's just as the amount of your money grows, that number grows as well. But it's always uncomfortable because there's always a number. It doesn't matter what it is. It's slightly more than whatever your tolerance is at that time. That's always uncomfortable. So maybe it's at $100 at first, but that becomes normal, but you're still 200's uncomfortable. And then 200 becomes normal, but then 400 is still uncomfortable. 400 becomes normal, then 800 is so uncomfortable. So it's this constant process of learning to push yourself. But nobody can tell you what that number is. And my personal rule is if you can't sleep at night, too much risk. If you can sleep at night, that's pretty good. That's usually the right amount of
If you're
risk.
checking your phone like every 5 minutes to see like, you know, what your account balance is, you're a little over leveraged, right?
Go do
So
something
you
else.
have to be comfortable with whatever that risk number is. So I think everybody was on board for $2 to make 8 and 20 to make 80. And I think we got to like 200. The numbers started getting like, you know, lighter and lighter. But that's how you determine like, you know, where you're going to get, you know, how much you're planning on risking per trade. Does that make sense? So it's always about keeping you safe and always looking at that risk to reward number. That's the only thing that matters when it comes to your entry and figuring out which stocks to trade and all that stuff. It's not really the price of the stock. It's whatever your risk to reward is. Now, granted, you know, there are some stocks that we just can't trade off the bat, like an Amazon or whatever, if you're buying shares and you have a limited capital. But once we get into other, you know, trading strategies like options and whatever, we can get into that. But in terms of stock, it's really just that simple, right? It's how many shares do you buy?
Yeah.
Does that make sense?
Yep.
How do we how do we count, like how many go back should we do? Is that a certain formula? Just 2. Okay.
Yep.
More data is not better.
Yep.
Okay.
It just makes you overthink it.
Okay.
Yeah.
Then, you know, because if we say 3, then you'll say, okay, then I'll do 4, and then you miss the train, right? The longer you're doing analysis, the more, and the stock price is going up, the more you keep missing your profit potential, right? Because your support number is not going to change, right? The only thing that will change will be your entry, which means you're giving up more gains as you wait to enter into the trade.
Got it.
And you also want to think about this too. Like, what do you think is going to impact price heavier? What's happened this week or what happened 2 months ago? There's
Right.
a heavier weighting to current events, news. Like right now, Corona's a thing, but 2 years from now, Corona's not going to be a thing, or at least I hope not, right? So it's always kind of what's in the most recent data is carrying the most weight on the company. So you going back further isn't going to give you some sort of edge. You just need enough to create an average. And what you'll find is that even without going back too far, like if you went back 100 of these ranges, they're all going to be kind of similar. Like not perfect, but I'm saying, let's say the range is in that example, 8 and 10. You'd find 8, 10, 7, 11, 9, 10, 8. It's usually about the same number because the same traders keep trading the same stocks. And we create a pattern for ourselves. And it's like a Pavlovian response. It's a little dinner bell. If you've traded the same stock 50 times and every time it goes up $8, it turns around, you just start naturally selling after $8. Like you don't even think after a while, right? And what happens is everybody doing that makes it happen because we all put our sell orders at the same place in the market. Therefore, price stops and starts to hang out there. And then it starts feeding into our belief even more. And then it starts to tick down. And then we're like, oh, yeah, we definitely were right. And we make it happen to ourselves. So every stock has what we call its own personality. But what that really is the habits of the traders that trade that stock. So it's every stock has different, like you have the Tesla fanboys, you have the Amazon people. And I've seen guys, people will make a couple $100,000 a year trading only 5 stocks. Like you don't need to go to a bajillion different places. You can go back to the same fishing well over and over and over and over again. And many people do. And that's why those ranges tend to be so similar, because we train ourselves. It's very, very interesting psychology when you start digging behind it, because it's really a game that we've developed for ourselves to play. And we make it move the way we think it'll move, and therefore it moves that way. It's interesting.
Yep. All right, Jake, since you kind of found me an example, do you want to share that? And then we can leave that as homework for them to kind of go play with and kind of see if they can come up with the numbers, and we can look at it next week.
Yeah, for sure. So I found something. I think I'm cheating. I think it was a tweet. Let me see. Let me double check. It was a. I think it's the same stock. So I did find it on a scanner. So I will say I did a scanner. I can. Oh, let me see. I'll show you. Share my screen. Um. I want to share my whole monitor. Can I not do that anymore?
Nope.
No, they don't let you do that anymore?
Nope.
Oh, that's some baloney, guys. All right. Well, let me just real quick prove. All right. Here, this is the thing. Let me go to my results on the screener. Oh, dang. All right, never mind. It disappeared. All right, but I did do a scan. I was trying to prove it. Never mind. All right, you're just going to trust me. It was also a tweet with Tackle Trading, so that happened as well later in the day. I saw it. All right, it's a gold company, though, and it's cheap. So I felt like a few things. Number one, if I go share a screen of gold. Okay, let's hop in here. Let's go look at gold, guys. Do you guys like gold, by the way? I don't know. I'm a gold bug. I am a fan. Gold is cool. It's shiny. You can pet it. You can lick it. It doesn't taste that good, but anyways, guys, gold has been running, right? You have this nice uptrend, nice symmetrical triangle starting to develop, okay? So again, let's talk about patterns here for a second. One thing that you'll find is that there is a plethora of patterns out there, guys. And I'm sure you guys already have this in your notes, but if you don't have this in your notes, make sure you write this down. There's only two types of patterns out there. One is called a continuation pattern. And guess what? It means it continues. Traders are not that creative. And then the second type of pattern is what we call reversal pattern. And guess what? It means it's going to reverse. So it's either going to keep going or it's going to change direction. That's all we got to work with. So each of those is like a main heading. That's like saying fiction, nonfiction, right? There's a lot of things after that, right? If you go into like subheadings and groups, lots of different patterns. This is what we would refer to as a symmetrical triangle, right? So you see this massive expansion up, and then if I connect these highs right here, what you'll see is that it's kind of pulling in, and if I start connecting these lows, I bet I can even come all the way back here. It starts to kind of form this little triangle, right? These types of patterns have a probability that it will exit the pattern in the direction in which it entered. So few base cases for this. Number one, I like gold setting up to make a big move in the upward direction. Again, now patterns aren't perfect. These patterns might work 60 to 80% of the time, depending on the pattern. So it's not 100%, but it's a more than likely. And the company that I found is a gold mining company. And guess what? They're gonna do well when gold's doing well. So it has this nice undercurrent to it, if you will. Now, it was EQX, showing Canada some love here, Canadian Mining Company, Equinox Gold Corp. Now, it's a $12 stock. I like this because it's affordable, right? So you can't tell me you can't buy it. You have $13, you can buy it, right? You skip Subway, you skip Chipotle, you can afford it. Now, when we look at this, I also like that, number one, nice trend. What kind of trend would we call that? I mean, it's clear as day, but
Trend. It's a bullish trend.
yeah, bullish uptrend, right? You say it interchangeably, it doesn't really matter, right? But you only get three choices, right? Up, down, sideways, but it's up and away, and man, is it pretty. Like, I cannot think of a prettier, just 45-degree line straight up into an infinity. That's what we like to see, right? It's not always that perfect, but that's what we want. Now, I liked this for a few reasons. Number one, I'm going to zoom in here. So what you'll find is, again, I highlighted the last few up moves. Jay asked that earlier, how many up moves do you kind of analyze? We could go back and analyze some of these even. That's not going to add anything to us right now, right? So what I'm going to do is zoom in, okay? So I'm going to look at the most recent information, okay? What we're seeing here is that for the last week, it was falling. It fell. It had a nice long tail right here. And this right here, guys, this is that blue line is what we refer to as a 20-day simple moving average. And what it does is it kind of it smooths out the data. So it just takes the last 20 trading days, averages them out, and creates a price point, right? these can act as catalysts for change. Not all the time, it's a potential catalyst. And in this case, it did end up acting as a support level. But also notice that the place that it kind of couldn't break below was also a ceiling back here. Coincidence? I think not. We're all paying attention, guys. All the traders are looking at the exact same stuff. You start seeing this stuff and it starts to seem so predictable. It's a little scary because it's like, oh yeah, it makes sense why it turned around at that price. Okay. But what the big news is today, that massive green candle, guys. That's what you wanted. That's confirmation. I'm not thinking it might go up. It's going up, right? That's no ifs, ands, or buts about it. The question now becomes, is it too late? Did I miss the entry? Meaning, did I need to buy it down here for my risk reward to be in the places that I want? Or can I buy it tomorrow up here and I'm still fine? That's the current conversation, right? This is why we go through the math. We don't just blindly buy. We look at where do we put our stop loss? Where would our target be? So on and so forth. So let's kind of, Em, let me ask you this. Are we actually doing this example or are we going to give it as homework? Am I building it?
No, we're gonna give it as homework.
Homework. Okay, cool. All right, so we'll get to see.
We can give them the data points and just kind of say, okay, these are the numbers.
Okay, yeah. So we'll get these data points for you, and I'll draw it out in my paint, so it'll be nice and pretty for you. All right. Now, I also want to let me clear this drawing set and zoom out for a second. One thing that you'll see when you're looking at this chart is that it's not as clear as it was in the PowerPoint. That's going to be a forever case. I'm just telling you this right now. Every pattern, every setup, it's not as pretty as a textbook. The only time you find textbook patterns are in the pages of textbooks. Only place they ever exist, right? Real world is a little bit more fuzzy. It's a little bit harder to see. But when we zoom in here, I want to see if you guys can see this as well. Do you see how from here to here, it had that nice run up before it fell? Right? It's kind of visual. If I start drawing these lines, it'll smack you in the face. Do you see if right from here to here, it had that nice run up? And this wick, by the way, is up to the exact same penny as that wick. Coincidence? I think not. But it ran up to that price and turned around, right? And do you also see from kind of this low all the way up to that high, it had another range, right? These kind of keep going up, down, up, down, up, down. Now, all we need is the last few, right? But you'll always be able to find this data. So let me zoom in here. All right, easier to see. Now, what we want to get, and I'll write down on my paint document and then share. When I put the paint in front of the screen, do you guys see that? Or you still see Thinkorswim?
No, it's Thinkorswim.
Man, I used to love that it would show the whole screen. I can move things around, and it's so much more dynamic for me.
Jake, inside Zoom, if you go to the little if you go down to that toolbar at the bottom, you can actually draw within the chart. So if you want to use that,
no shit,
yeah.
Really? Oh, that's cool.
There's a little drawing.
Annotate. Whoa, we're getting fancy tonight, people. All right, let's see. All righty. I like this. Let's see. All right, let's see it. All right. Oh, but then I can't use the cursor.
Yeah, like
it's one or the other, huh? Okay, that's all right.
You can at least direct where it is, and yeah.
That's all right. I'll leave it off. All right, so what we're gonna do is we need to see the last couple ranges, last two specifically. So what I do is I just put my cursor up here, and we're looking up for the L specifically, and we find that the low is 1126. So if you're taking notes, what I would do is I would literally draw a zigzag like this. That's what I do. Guys, when I'm building trades, I have scrap papers galore, and I build a zigzag. I literally draw it like that. Like my paper looks like this on a blank white piece of paper, and then I fill in the data points that I need, and then I do the math off that, right? Everybody has their system. That's my system. Okay. The first number that we want to write, which is the absolute low down here, is that low of 1126. So 1126. I'm just writing this down on my paint over here. Let's see, because then I can share a pretty screen. Let me organize my screens. Man, we got too many screens, it becomes a problem. All right. new. Let's make this look better. Okay. All right, you guys are gonna have to bear with my drawing skills. You're gonna see them here in a moment. But 11, 26. Beautiful. All right, that's the first one. Then it ran up to a high up here of 1265. So that's the next data point that we need, the 1265. Then it fell down to a low, an absolute low over here of 1156, 1156. Then it ran up, up, up and away. And because, again, it's the 52-week high, right? The 52-week high and low always get bubbled on your chart for you. It makes it super visual, very easy to see. It's right there in the bubble. And you can see it says that that absolute high in 2 locations, right there as well as up there at the top is 1366. So we put that in our notes, 1366. And then it fell all the way down to the low, 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 low price of 1209. That was the absolute low. And then the current market value is 2 locations. So you have it right here on the hard right of your chart. And then you also have it up here at 2 locations you pick, but it's 1291. So we're 80 something cents above the floor that we created. So 1291. Okay. Those are almost all the data points. The last thing we're going to need is our ATR. So I have a fancy little thing up in the corner that gives me expected move as well as ATR. But for anybody using Thinkorswim, I can show you something. If you go into this little beaker button up here and you click the beaker, it allows you to add fanciness to your charts. Now, I want to give a little fair warning here. The fancier the chart, typically the less money that trader makes. I want you to think about this for a second. I've seen people, and I walked in, and their chart had so many lines and crosses and the craziness on it, they couldn't even see the candles anymore. Right? And they're just looking for the next best line to tell them when to buy. There is no perfect line. There's no perfect anything. The best thing you got is your eyeballs and candles. That's the #1 tool you got, okay? So I don't want you guys to ever get stuck down the rabbit hole of having a ton of indicators or something. I would actually prefer if you guys were running off of clean charts and your charts look like this. If you learn like that, you'll be far better off long term, because every indicator in the world is built off of price, volume, and volatility. We can see that with our eyeballs. Is it moving fast? Are a lot of people buying it? Right? And where is the price? So you actually, price tells you first, indicators typically lag. So it's not a perfect thing. It's so I want to make that kind of public service announcement first before you get down the rabbit hole of indicators. But what you'll find is that ATR is one of the A's. It's always listed right there. You can add it. It's a default. I'm not going to get into the differences and what different ATRs would mean, but it just adds it to the bottom of your chart. Okay. And what this does is, think about ATR. It stands for average true range. It doesn't mean anything to you right now. Just think about it as how much is a typical day's move. That's what it's asking. So it's normal right now for this to move 57 cents a day. That's normal. If it moves $2 and we see that the normal right there at the bottom says 57 cents, we're like, wow, that's a big day. If it moves 20 cents and the norm is 57 cents, wow, that was a really small day. It's just giving you something to relate to, right? But contextually, when you're building your rules, it'll also, when we're putting it half of an ATR under support, we're making sure that, again, support's more of a zone than it is a single price level. You're putting it a half day's move under the level that it already created. It's a serious break. It's not 1 penny under. It's not barely starting to break. It's a serious move, okay? So right at the bottom, you can see it's 57 cents. So our ATR, 57 is going to be hard because it's going to give you an odd number, but deal with it. That's the real world. It's not as pretty as PowerPoints. Okay, 57. All right, so now if you've been following along, let me share a different screen. You should have a screen that looks like my screen. So let me, can I just, if I hit new share and I press that, let's see if this changes it. Okay, do you guys see my paint, my beautiful drawing skills? All right, not so beautiful, right? So it doesn't really matter. But this is what my pen and paper typically look like when I'm building a trade. This is everything you need. If you go back and stare at that chart any longer, it does you no service, nothing at all, right? You're looking for something that's not there, right? So this is where we start to do our math, right? Now, I'm not going to do your homework for you, right? But one of the things you're going to want to figure out is what that range was. One of the things you're going to want to figure out is how big that range was, create an average there to kind of figure out where our future target is. I would make your entry price just the current market value. Don't use any of those fancier things that I typed in the chat. Those are 1-2 months down the road. That'll make you more strategic in your trading. It won't just be buy at this price. It'll be a better entries type system. But again, you need to be able to make sure that you can just click the button. Don't get overwhelmed. Just click buttons. Okay. Think less, click more. That should be one of your mantras. Now, we want to be able to get what our target is. So what are we looking for? We're looking for a number for our target. We're looking for a number for our entry. We're looking for a number for our stop loss. We're off of those numbers going to be able to find what our risk is. So we're going to have to do that math. Off of that, we'll also be able to figure out what our potential reward is. Be able to figure out that. And we really are looking for the ratio of those two, right? So we find the S, the E, the T. That helps you figure out what the risk and reward is, all to get down to the final, what we call the RR, the reward risk ratio, what that is. That's our end goal from all this math, right? Eventually what you'll find is that you can get away, some traders can get away with a 1-to-1. If you're a really good chartist, like I'm saying, like you're like a chart whisperer, you can get away with risking $1 to make $1 because you're going to win most of them. I personally never trade like that because I don't like forcing myself to be perfect. We're not, right? I like having wiggle room. Like if I F up, no big deal. Having rules like what M gave you, meaning reward of $2 while only risking $1, means that if you're right only 4 out of 10 times, you're extremely profitable. So that's where that you can kind of set yourself up for success. So
Hey,
those
Jake,
are all the things we're looking for.
do me a quick favor, and I did not realize that we are half an hour past our time because you and I can just talk all day long about this stuff, and I'm
I was
sure
getting excited, man. Okay,
Oh my
I
God,
apologize,
what are you
guys. I'm so sorry.
we apologize for going long, but
No, that's fine. That's fine. It's
put
okay.
the decimal points on all those numbers so it doesn't get confusing, if you don't mind, before I screenshot that and send it to Bo, or before you screenshot and send it to Bo. So
You really? I was hoping people would just write down for themselves. This is some ugly writing, but all right, I'll give it to you.
It's
I'll
nice
screenshot
enough.
it.
We'll
All right,
share.
whatever.
So Jake,
Yes.
this is Pamela. You're saying this is basically how you look if you're going to do a trade.
Mhm.
You go through all of this, right?
Yep.
Yep.
Okay.
And that last ratio down here is
Right.
the green or the red light. It says go,
Right.
no go.
Okay.
Yeah. And then if it says go, and ideally it's a huge multiple. Like ideally I can make $10 for risking 1. They just don't happen very often. Then you already have the numbers of where do I buy, where do I sell if I'm right or wrong. And then you just set those orders right in the market. You can automate it from there, like Em said. You could literally plug all the numbers in, say for tonight, for tomorrow, for the market to fill, and then you don't even have to ever check it again. Like it would just handle itself, and the trade would be taken care of, which is kind of cool. So a lot of our newer traders, when I was teaching people, because a lot of people, they work full time or they have a lot of other obligations, they don't want to maybe check during the day. They just set them up at night and let them ride. And as a long-term investor, I would probably do something similar to this to just look at potential. but that's a little bit different. But any timeline of trading, I would run through this scenario: position trading, day trading, swing trading. The hardest part about day trading, and why I usually recommend people don't start there, is because you have to get all the way down to your ratio while the price is moving. So you need to get to that final number, go, no go, and you have like a 3-minute window. So in the beginning, it maybe is a little fast. In the end, it's like you just do this so often that eventually you can almost eyeball it. Like, it sounds bad, but like you say, oh yeah, good, right? You don't want to do that in the beginning, but that's almost where it becomes. So.
All right.
Thanks for the info, yo.
Any questions, guys? I know we went through a lot today, but you know, this is the fun stuff. This is when we get to the point where we start to click the buttons. But again, it's always going to be about risk management and understanding whether, you know, whether it's a go or no go once you run the numbers, right? We don't just buy blindly just because we like the pretty picture in the chart. You still got to run the numbers and be able to analyze it and determine whether it's a go or no go because of that risk, right? You want to be able to keep and maintain most of your money, you know, when you have those rules in place. Otherwise, you're just trading. Then it becomes gambling, right? If you don't have those rules already applied, then trading becomes gambling. And that's what we're trying to prevent. We want to have you guys trading, you know, 5 years from now because you have these foundations in place. Does that make sense?
Yes.
I will also say, guys, I didn't actually do the math yet, so it might not be a good trade. So you're gonna have to tell me next week. Because I literally just found it. I didn't even do the math yet, but that's the real world. Like, I can't tell you, you'll do 4 of these a day, find 2 good ones and pick the better. And that's your day. Like, that's what a trader does. I used to have a rule. I've stepped away from it now, but I used to require that I trade one trade every day. And that was literally my daily routine, is I'd do like 3 or 4 of these and then pick the best one and send it. And that's it. And Monday through Friday, that's what I do. So.
Awesome. Well, I guess we will end it here and we will pick up where we left off next week. We're gonna be here for a while, guys, in terms of technical analysis and charting and all that stuff, because we then have to get to order entry and scanning and doing all that good stuff. So we're just gonna keep, you know, pushing the metal to the pedal every single week when we meet. So if you don't have those brokerage accounts open yet, definitely open them up. Get your paper trading account up and going. And then we'll take it from there next week.
All right, just a couple of quick notes. I will have the video uploaded tomorrow. I will get this PowerPoint presentation from Emily, so that way I can put that on the website as well. And then if you have any questions, you can reference that. Figure out the homework assignment, you know, take your time, understand it, don't rush, but try to understand the numbers. And then we'll blame Jake if it's a bad trade.
It's fair.
Tomorrow we have our party chatter through our investor party platform. Emily's going to be on. Friday. Sorry, my days are confused. Friday, Emily will be on. She'll give us a market update, and then we're going to have Don Pendleton with Protect Wealth Assets. Correct? He'll be on as well, so that'll probably be a good conversation for everybody to chime in on, just to have a better understanding on how to protect your money and your wealth.
Don's a great guy. I love Don. That's something not to miss.
Let me put it this way. Jay, Jennifer, even Brianna, it's required. Oh, Kathy? Yeah, it's required.
We'll get that link out too, just to make it easier. I will send that in an email message to everyone. So, what else, Jacob?
I think you caught it all.
For those of you who don't have Facebook, I understand I'm not going to make you get it, but it's just going to make communicating a little bit easier. So let me know whenever you have an account signed up. Just shoot me a message with your name or an email address on there that I can find you and add you in onto the group chat. We've already got it started. For those who got an invitation from Jacob and myself earlier, please accept it, join it.
Where was the invitation? I mean, I may
Jacob
be
should have
already
done it.
part of it. I don't know.
I'll make sure you're in, Pam. Don't worry.
We also want to make sure that, has everybody started reading The Creature from Jekyll Island? No? Okay. It's going to be it's a bit long, so you guys need to start reading that just so we have something to talk about. It is a bit long, but we're just trying to get through the first part. A little bit. But we'll see what we can do. But it's going to be, you guys need to understand what money is so you know what you're trading. Does that make sense? Like Emily's already said before, like it's a lot of it's emotion, it's a head game, it's a mind game. So you got to get out of your head. So we're going to try this. It's actually really interesting, especially the first part. So that's about it. So start downloading that on Audible and make that a thing. I think that's about it. Has everybody made their profile on Investor Party? Oh, I showed you that tonight, right? So you guys can all go and look at it. Okay. That did not get recorded in the beginning of the video, but we'll go through it again next time. Guys, you are wonderful. Good night.
All right. We'll see you all on Monday. Okay.
Bye.
All right. Good night, everyone.